Hello and welcome to this latest edition of our course on demand, which has been brought to you by Forex Academy. So in this course, we will be discussing mastering price action trading. So just before we get in and explain what's involved, please do take a quick moment to read through our disclaimer. The information is there currently up on screen. Do feel free to pause this recording if you need additional time. Okay, so let's start with a webinar outline. We'll look at the principles behind price action. We'll have a look at what you would need to consider if you look to master these principles of price action. We'll look at the importance and the role that Japanese candlesticks will actually play in that decision-making process. We'll look at their price action patterns, which are then created. We'll have a look at the role of technical analysis, and we'll finish with just an approach in which you can look to master price action trading strategy itself. Okay, so let's start with price action principles. So price action trading is the discipline of basing all of your trading related decision-making processes on historical price movements that are displayed on a particular price chart. So price charts reflects the beliefs and actions of all participants trading the markets during a specified period of time. And it's these beliefs that are portrayed on a market's price chart in the form of price action. So whilst economic data and of course other global news events are absolutely the catalyst for price movements in a market, technical trading assumes that we don't need to analyze them in order to trade the market successfully. Now, the reason for this is a very simple one. All economic data and world news that causes price movements within a market can ultimately be reflected solely in the price action or the price on a particular market's price chart. So if we talk about the value of the US dollar or the gold market or the oil market, for example, then all of that information is taken into account, and that price will either move higher, it'll move lower, or it will continue to stay roughly at the same level. And it's this information that those that trade price action can use in a very, very useful manner. It's also important to take on board that due to the fact of recent technological advancements and the development of Japanese candlestick charting, a lot of that has been responsible for the popularity of price action trading today. So it does allow traders to recognize when certain structures occur in a market, and it also gives them the information to understand what they mean in terms of price change and how likely price is to move in any particular direction, which that's to the upside, to the downside, or potentially continue to move sideways. So what you'll often find is many good trading opportunities occur even when price action traders realize that price structures break down and reject areas of interest. And we call these types of scenarios structural failures. So even when you see structural failures and price does not behave and act like you anticipate it to do, it still presents some fantastic opportunities for those that trade price action. So in order to master price action trading, traders must gain the experience in seeing price action set up on numerous occasions, so you can build up the confidence to trade these setups and navigate through the financial markets. So a good analogy to use when we talk about price action is to think of trading price action like reading a book. So the entire book, of course, tells us a story, just like the market does on a daily basis. So what you'll find is overall themes develop with many interesting plots and subplots throughout. And it's the same for the financial market. So then when you go down into a bit more detail, think of each individual page as perhaps presenting a trading day, which can then be subdivided into paragraphs or little subplots. And these can be seen as effectively different candlesticks or price patterns, which could be effectively be the words on the particular page. And all of this is really useful information. Now, the market will trade each and every day, just like reading a long story. So as the theme or the story begins to develop in a book, so does the theme of price action in a market. So it's quite a useful analogy just to explain that it is like reading a story. When you're looking at a price chart, it gives you some very, very valuable information. And if you can read that price chart, it can give you some a significant edge when trading. Okay, so just looking at the foundation of price action, it's important to note that if we look along the x-axis, what you'll see when you look at a price chart is the time frame of the chart that you're looking at, and along the y-axis you'll experience the price. And what you'll experience over this time frame is how price moves during this particular period. And what's important to note from just looking at the price action that we're seeing on screen currently is that this market moves from bottom left. Okay, does move sideways a little bit for a period of time, but then starts to push higher and is currently trading top right. So in general, overall, this market is moving to the upside. And this just happens to be a euro dollar daily candlestick chart. So we're constantly experiencing a battleground. And a battleground is just, it's where buyers and sellers come to do battle. Buyers are looking to push prices higher, and of course, sellers are looking to push prices lower. And whoever wins out will see a chart move in that general direction. So we can experience a consolidated market for a period of time, followed by a little bit of bullish price action. And you could argue as well a little bit more consolidation, which is often what you get after a big bit of price action pushing prices higher. Okay, so that's just touching upon the concept and the idea behind the battleground. And it's important to note that all price action trading decisions are made here on this chart, or on a chart, should I say. So deciding when to buy or sell is made purely on what is happening to price of price action. So we can glean some very, very useful information from what we're currently seeing that can give us an edge when we look to navigate these markets. Okay, so moving on to mastering price action, there's a number of things we need to understand, and the first one is to understand the principles behind Japanese candlesticks. We then need to recognize price patterns, which is a collection of candlesticks, and technical structures which exists in the markets, and price moves from those structures, but can also break down those structures as well. So that's important to acknowledge. To master price action, you need to develop a price action methodology, and that's just a way in which you can look to enter and exit these markets. And of course, you need to be in the markets long enough to be able to gain the confidence necessary, which will allow you to also eliminate hesitation, because hesitation can prevent you from actually getting into those trades. And try to gain that all-important experience by learning from each technical setup and acknowledging how price behaves in those situations on a number of occasions. And that's what will give you the confidence to be able to master price action. Okay, so focusing upon Japanese candlesticks in more detail to begin with. In order for price action traders to consistently profit from trading, they must find a way to effectively assess how prices are trading in the markets. Now, observing Japanese candlesticks is the best way to do this. So these candlesticks describe the interaction between buyers and sellers, and they tell us who has more control over price direction. So if we talk about that battleground, are the buyers in control of that market, or are the sellers? And if you understand that, and Japanese can help us with that, Japanese candlesticks can help us with that, then you will give yourself a really good basis in which to navigate these markets. Also, the size and shape of each candlestick provides us with unique information, such as the trading range of the market within each particular time period, whatever that may be, and how much pressure there was on either pushing prices to the upside or, like I said, to the downside. So this is how Japanese candlesticks and our understanding of these candlestick patterns can really assist us when we trade. And to just give you a good example of this, why are they so important in deciding price direction? Because when you can blend them with easy to identify levels of support resistance, and you see price action interacting and behaving with these markets, and if you can see these three candlesticks are very, very bearish, i.e. pushing prices to the downside. But what you can clearly see is price then becomes supported at this particular level, because it's understood by the market as a level of support. So what you see is a little bit more indecision and price action just becoming a little bit erratic. But what is also created beneath this low is actually an opportunity for certain types of price action traders. And what we will see at the point of this particular breakout, which is prices breaking through the level of support and pushing lower, is that breakout traders will look to enter to the downside, looking for a breakout to the downside and looking for these prices to push lower. So those would be your breakout traders. They'd identify this level of support and said, if we get a break of this level of support pushing lower, we would like to go with this market. But in reality, that's not what we see. What we see is actually a little bit of a rejection to the downside. So this is now a rejection candlestick. So prices were pushing lower and we got to a low price, and then we started to push higher. And as you can see, there's a little bit of a rejection of prices pushing lower. And it actually creates a hammer candlestick pattern. Now that's quite interesting because it hammers out the bottom of the market. And what that can do is present, if we talk about this battleground, it can present opportunities to the bulls to actually look to drive prices higher. So as we roll on the next couple of days, you can see a little bit of indecision kick in the day after. And then on the third day, which is why you don't want to necessarily make decisions based on one candlestick alone, that you need a succession of candlesticks in order to make consistent decisions when you trade. As the breakout traders are stopped out to the downside, prices push higher. And what they do then is they take out stop losses as prices push higher. And this results in giving bulls the opportunity to actually look to take control of this market. And what we mean by that is the sellers are no longer in control at this particular point. So now the bulls are seeing this candlestick, they're identifying the rejection to the downside, and they're now looking for opportunities to buy this market. And as you can see, we get that explosive move in this particular example. And you just got to be patient to wait for this type of setup to occur and use your understanding of Japanese candlesticks to help us decide price direction. And that's how price action traders use their understanding of Japanese candlesticks in that way, and look to stack the odds in their favor. So moving on to price action patterns, a primary advantage to basing trading decisions purely on price action is that you can adopt the time frame of the trade to the current price action patterns in the markets. So being able to navigate and negotiate different time frames can really prove quite useful. Now, analysis may point to a high probability trade where the trader may want to trade the market to a certain price. So in mastering price action, it is important not to judge each technical price action setup by simply observing any one particular candlestick. So it's not about looking at the hammer candlestick in isolation. It's about looking at the information that gives us, and then looking at the reaction of the markets and see if those buyers actually do come into that particular market, at which point you would then be looking to stack the odds in your favor and have significant reasons to get into that particular market. So this, of course, depends on the time of trade. More frequently, however, it is the arrangement of the Japanese candlesticks over a longer period of time that can indicate longer term trends and hence greater trading opportunities for price action traders. So to give you a good practical example, I want to draw your attention to 3 significant candlesticks on this chart as represented there within those circles. And in observing individual, almost standalone candlesticks, we are able to find enough evidence of price direction. So here we see 3 strong bullish candlesticks, which indicate strong trend continuation to the upside. So that is effectively all what these candlesticks do. But there's a lot that happens just prior to this candlestick. And this is on each occasion, what we see and experience is a close above previous resistance levels on each of these occasions. And we can see that the previous price action is quite bullish. The price action that comes before these candlesticks on each occasion is bullish and does push prices higher. And the decision-making process for a trader that uses price action is quite a straightforward one. It's looking to go with that particular market. And this price action and volume pushing prices higher means that a part of your decision-making process is determined by whether you're looking to buy or sell a market. And in this particular example, you can clearly see that you'd only be looking to buy this particular market. If you want your more high probability trade outcomes. So of course, there's traders that sell the highs and they keep looking to do so, but that's a very, very risky, low probability in terms of looking to see a successful outcome. So hopefully that helps just a little bit in terms of getting an understanding for price action patterns. And if you can identify significant levels and you have a solid understanding of price action patterns, then that can really look to stack the odds in your favor when you trade these markets. Okay. So again, looking at this other example, you can clearly identify a significant level of support and resistance, and it's support and resistance because what we do is this level can provide resistance, preventing prices pushing higher until we get that breakthrough where you would then be looking to buy this market, and then it provides support around these prices, looking on multiple occasions to push these prices higher. So that's why they're genuine levels of support and resistance. And to just roll this on just a little bit, what we can see here, just on the right-hand corner of the screen, is a fairly well-developed bit of price action pattern, which can help you define your directional bias, meaning are you looking to buy or are you looking to sell this particular market? Now, in this case, we're going to propose the case for a short gold trade. And I want to do a little bit more understanding of technical analysis and our understanding of price action as well to highlight these areas and to suggest that in actual fact, what we're experiencing here is a series of lower highs, meaning that there is now at this point, there is a downward pressure looking to push prices lower. But as you can see, this is also a level of support. So prices are supported at this level, which is important to see and important to identify. And what I'll do is I'll actually move this along so you can see these pre-identified levels, just working at these lows. So considering this particular pattern, this particular structure, traders can now look at how price action reacts at very important price points in the market. So how a price action trader can utilize this information, we can create what is called a descending triangle, which again is more technical analysis, where we have the downward price pressure looking to push prices lower in this particular example. So a fairly straightforward approach would be, if we get a confirmed break beneath this level of support, then that would mean a lot of these traders which are looking to buy these markets, they'd have stop losses sitting in these areas. They would turn to sell orders, and what you're likely to do is to get an explosive breakout of this descending triangle, and you're very likely to get an explosive move around this kind of price action, pushing prices lower. So this is a sort of an isolated example in terms of how a trader can use their understanding of price action and the patterns which exist in these markets to formulate a bit of a trade plan for a market such as this gold trade. Okay, so price action patterns. So sticking with these just a little bit longer, let's now look at a different pattern. And as you can see, we've got a very easy to identify level of resistance in this market, preventing prices from pushing higher consistently, and also clearly an easy to identify level of support, preventing prices from pushing lower in this instance as well. Now, it's always important to acknowledge that you need a methodology for looking to make trading decisions around these areas. That it's not as straightforward as necessarily buying above this level and selling below the level. You need certain confirmations to be able to enter and exit, which we'll discuss very, very shortly. But what we mean by this is traders often observe a trade price pattern when they are trading even within a range. So we have range-bound traders that look to buy the lows, push prices higher, and then when price reaches a level of resistance, they're looking to sell and drive markets lower. And this sort of just occurs time after time after time. But these are very much your range-bound traders. These are the trades that these traders look to trade. Now, all of these trades don't necessarily need to be winning trades. And again, even a range-bound sideways moving market like this can present fantastic opportunities for, again, your breakout traders. You know, those that break below a certain level could constitute a very interesting opportunity to either push this market lower, or if we trade with confirmation above these kinds of levels, to look to push these prices higher accordingly. So again, you know, different types of price action patterns can present different opportunities to different style of traders as well. Okay, so hopefully that makes a little bit of sense. So in a range-bound market, meaning prices are moving from lower range to higher range, the best opportunities may actually lie in trading the price action at the range extremes by seeing how the price action reacts at these levels. So we're not suggesting for a second that if you decide to buy above this high here, if you get the confirmed break above that level of resistance, that of course that might constitute an opportunity to buy this market. However, as you can see, subsequent price action would confirm that that particular trade idea would be a losing trade in this particular example. But there's many other examples which would protect your capital by showing and proving to you, if you wait for confirmation and you wait for the close of these markets to reveal what opportunity may or may not exist, it can protect your capital more often than not, and that's worth taking on board as well. Okay, so moving on to the role now of a technical analyst, or the role of technical analysts. Although pure price action traders will rely only on their skills in reading the structure, but also the movement of Japanese candlesticks, most technical traders profit by devising a strategy which actually combines both price action and their basic understanding of technical analysis. So they actually work hand in hand with each other. So this is because technical analysis can help traders decide when it is most important to observe price action and how significant the price action is at the market's current level. So when we talk about technical analysis, this is the umbrella term for being able to trade markets technically. And then within that, you have the observation of focusing on price action and the information that Japanese candlesticks can give us in order to make consistent decisions. So as more and more traders have embraced this trading approach, price action volatility is often seen to increase when the market reaches these technical levels of interest. So technical traders can now look for more evidence to support trading decisions in and around these technical levels. So to present to you a good example to explain what we mean in a little bit more detail, the role of a technical analyst is quite it's a very interesting one. So important to acknowledge that gold is said to be a very technical market, and now the reasons for that is what you can see currently up on screen. So those that are your technical analysts will use a series of different potentially technical indicators, whether they're support and resistance, whether it is Fibonacci levels that you're working with, whatever kind of technical indicator is used, and people have different, they prefer different indicators for different reasons. It all forms part of the same picture and the same ability to actually make trading decisions. So with this fib level, you can see that there are actually levels of support and resistance as well, and they do stack up quite well. So if we look at the 38% retracement in this particular example, it can provide you with some very, very interesting sell opportunities on numerous occasions. And also the 50% retracement and the 61.8% retracement. There's only a couple of examples in here just to show you that if you apply technical analysis in a certain way, then it can give you an opportunity to again look to stack the odds in your favor when you trade these markets. So what we can identify as well is these genuine levels of support and resistance, and price action trades uniquely around these technical levels. So this is the important point to take, and again, it's really focusing on the confirmation that you need to actually make a trading decision, is what will be all important in terms of your ability to trade these levels consistently and of course profitably. Okay, so looking to master price action trading strategy itself. Now, a couple of pointers is that a good combination of technical analysis skills and price action strategy is the preferred methodology. So looking to combine technical analysis using perhaps one or two indicators perhaps with your understanding of price action is, if you're looking to master price action strategy, it all works together very, very nicely. You'll need to have exit and entry points, which can be based both on the technical levels and the structure of candlestick patterns. And if you do that, you start to allow yourself to master price action and build out all important trading strategy. So it is important to note that confirmation is always required before entering these markets, and confirmation unfortunately means different things to different people. So it may just be the case that you're looking to get a close above or below a significant level of importance before you actually make that trading decision. And what that will do, it will reduce the potential for false breakouts, even to the upside or to the downside. So if you can protect yourself against those and have a way to seek confirmation before you actually pull the trigger and get into that trade, then that is all important and something very much to be to be promoted. So the technical setup itself of the trade can help determine the term of the trade. So here we're talking about the technical setup to identify perhaps range-bound trading, for example. And finally, the more price action patterns you observe in the markets, the more familiar you will become with that movement of price. The easier it will be to trade that with significant confidence as well. So all of these things are very important with regards to looking to master a price action trading strategy. So working with this, let's have a look at how you can use price action trading to actually look to enter this market in a very consistent manner. And again, we're looking at price action on screen with a very, very clearly easy to define level of support and resistance, as you can see up on screen with this blue dotted line. Now, it's important to, as we're reading this book or reading this price chart and seeing what's unfolding, it's important to know that, you know, simply your breakout traders may be looking at this price action in this area, and they may decide to become buyers if price action breaks the long-term resistance level. So this is a level of resistance preventing prices from pushing higher. And if we get a breakout of this level, then what that might signify is an opportunity for buyers to actually get in. And certainly these are your breakout traders. They'd be looking to get in if you clearly see a breakout of this level. But as you can see, it becomes a fairly significant level of resistance over a significant period of time. And in fact, the market bounces off that level before attacking it again. And if we move this along, we can see the low of this market, and you can see that it actually starts behaving a little bit more consistently prior to getting to this level of resistance, which prevents its prices pushing higher. Now, traders have some interesting opportunities around this level of resistance. So if the price breaks, and as you can see, it breaks above it, it might give breakout traders an opportunity to go long this market. But it also, as you can see, it pulls back over the next 3 or 4 days, and actually below the initial resistance level. Now, if you're a technical trader and you look at price action, you can see that this is a pullback off the highs. And what we see from here is a pullback from the breakout high. And if we look at it in a bit more detail, what this can do is it can present another buying opportunity, but at a specific place. And that would be potentially to buy above this particular candlestick high might constitute a great opportunity to start pushing this higher. So when we get breaks at these levels, it can provide opportunities for breakout traders to get into this market, to push it higher. But also, you know, those that trade pullback price action, you can get multiple opportunities on the same bit of price action with the overall view to expect prices to push higher. Now, they don't have to behave in that way, but you would expect them to do so. And if the market behaves as you expect it, then that is very, very important. And if it doesn't, then that is the first question mark that should be placed in your head in terms of whether you continue to give this trade more room. Okay, so that's how you can use your understanding of looking to master price action in the form of a strategy, and hopefully the challenge is to try and use that in a consistent manner over the medium and longer term. So this effectively becomes your buy entry level. And as you can see in this particular situation, market continued to move to the upside quite aggressively over the next few days in this particular example. Okay, so that is your entry strategy. So sticking, and as you can see, you got that explosive move pushing higher. So now looking to use your understanding of price action trading in the form of an exit strategy. And we're looking at that same buy entry. And again, this is the same resistance level sitting in this market. But now that we have a buy entry, we can look to place a technical stop loss and potentially even look to place a profit target on in this particular trade. So we know exactly where our buy entry was, as we've just previously explained. Now, in observing the price structure of the price action, if we can use the last corrective low, the question we would need to ask ourselves is, can we use the last corrective low as a technical stop loss? And for us, the example would be the market continued to break higher above that level. So yes, we can use that corrective low, because if the market pushes higher and it breaks back beneath this level, then you do not really want to be in this market beneath this low anyway. It doesn't make any, it doesn't make for sound decision making to actually be in this market beneath that level. So you may as well use it as a very consistent place to place your stop loss. So that's how you can use your understanding of price action in terms of an exit strategy. And you're still seeing that explosive push to the upside. So as price moves to the upside, we can then assess the price action for potential reversal patterns and potential profit targets as well. So we can continue to use our understanding of price action to help us get out and maybe even book in profit on a trade like this. So in observing the structure of the price action, we can use the last corrective low as a technical stop loss. And that's what's all important when we look to use our understanding of price action in the form of a trading strategy to look to make sure we place, we exit the market at a level that makes sense, and that can protect your capital if the market moves against you. Okay, so that just about concludes this particular webinar. So we looked at some of the principles behind price action. We looked at the concept of looking to master price action and some of the things that you would need to consider as a trader. We looked at Japanese candlesticks and the information that can give price action traders, and then putting it together in terms of looking at price patterns, and again, the way in which that can look to stack the odds in favor of a technical trader or a trader that trades price action consistently. We had a look at the role that technical analysis can play, the use of potentially other indicators to formulate that strategy, give you more confidence, to provide you with more confirmation to actually get into that particular trade. And we just finished upon looking at how we can use price action to actually formulate a trading strategy, which can be based on objectivity and managing risk, and just looking for very clean opportunities to get in and navigate these markets accordingly. So all that's left for me to do now is to thank you very much for joining us, and we do look forward to seeing you next time. So from everyone here, bye for now.